When startups need funding, they can take many different paths. Two of the most talked about options are venture capital and crowdfunding. Both can provide the capital necessary to grow a business, but they work in fundamentally different ways, attract different types of investors, and have different implications for a startup's long-term strategy. Let's start with crowdfunding. Unlike venture capital, which involves securing large investments from a small number of professional investors, crowdfunding raises smaller amounts of money from a large group of individual backers. Crowdfunding can take different forms, but the two most relevant for startups are reward-based crowdfunding and equity crowdfunding. Reward-based crowdfunding, used by platforms like Kickstarter and Indiegogo, allows startups to raise money by pre-selling a product or offering exclusive perks to early backers. This is popular with hardware, tech gadgets, and creative projects where backers fund the production of a new product before it hits the market. Equity crowdfunding, on the other hand, operates more like venture capital, meaning that investors receive equity in exchange for their money. Platforms like Seedrs, Crowdcube, and Republic allow startups to raise funds from the public in exchange for small ownership stakes. This approach democratizes startup investing, allowing everyday people to participate in funding high-growth companies, something that was once only accessible to venture capitalists and angel investors. Now, let's compare this to venture capital. Unlike crowdfunding, which is open to the public, VC funding comes from professional investors who specialize in high-growth startups. Instead of contributing a few $100s, VCs invest millions in exchange for significant equity and influence over the company. VCs don't just provide money, they also bring industry expertise, strategic guidance, and access to a powerful network. They take an active role in helping startups scale, often joining the board, advising on hiring, and pushing for aggressive growth strategies. Crowdfunding investors, in contrast, are typically passive. They don't have voting rights or a say in company decisions. Another key difference is the expectation of returns. With crowdfunding, particularly in reward-based models, backers don't necessarily expect financial gains. They're often supporting a product or mission they believe in. In equity crowdfunding, investors do seek returns, but they lack the direct influence that VCs have to push for growth, exits, or acquisitions. VCs, on the other hand, invest with clear exit strategies in mind: IPO, acquisition, or a major secondary sale. There's also a big contrast in risk and due diligence. Crowdfunding investors typically invest with limited access to financial data, relying more on the founder's pitch and the appeal of the product. In contrast, VCs conduct extensive due diligence, analyzing market size, financials, competitive landscape, and scalability before making an investment. This means that while VC-backed startups often have a higher survival rate, many crowdfunding projects fail to deliver, leaving backers with little recourse. So, which is better, crowdfunding or venture capital? The answer depends on the startup's needs. Crowdfunding is great for product-based businesses looking to validate demand, build a community, and raise funds without giving up significant ownership. VC funding, on the other hand, is better suited for startups that need large amounts of capital to scale rapidly and want strategic investors who can actively guide their growth. Some startups even use both models together, starting with crowdfunding to generate buzz and prove demand before approaching VCs for serious growth capital. Others see crowdfunding as a way to maintain control and independence, avoiding the pressure that comes with venture capital. At the end of the day, both venture capital and crowdfunding play essential roles in modern startup financing. Choosing the right one depends on the startup stage, industry, funding needs, and long-term vision. Crowdfunding allows startups to raise money from many small investors through either reward-based pre-sales or equity stakes, offering accessibility but limited investor involvement. Venture capital, in contrast, involves large investments from professional firms that provide not just funding, but also strategic guidance and active influence. While VC funding demands due diligence and high growth expectations, crowdfunding is more flexible and community-driven. Many startups leverage both, using crowdfunding for initial traction and VC for scaling, while others prioritize independence by avoiding venture capital pressures.